All right, let's jump right into this explainer. Today, we're acting as expert investment analysts and putting Morgan Stanley's stellar Q1 2026 results through the ultimate test. We're going to run this financial powerhouse through a gauntlet designed by history's greatest investing legends, and we'll mix in some modern quantitative models too. We need to see if this stock is truly a buy right now.
So, here's our roadmap. We'll start off with a quick company snapshot, then we're going to view it through the lenses of Warren Buffett, Peter Lynch, and Benjamin Graham. After that, we'll dive into DCF and other models before bringing it all together for our final verdict.
Section 1. Company Snapshot. Evaluating the contender. Let's meet Morgan Stanley. They are fresh off an absolutely massive start to 2026. And honestly, the numbers they just dropped are turning heads all over Wall Street.
Morgan Stanley is firing on all cylinders right now. Just looking at Q1 2026, they posted a record $20.6 billion in net revenue. That's up 15% year over year. The institutional securities division alone hit a record $10.7 billion. But the real jaw-dropper here, they achieved a staggering 27.1% return on tangible common equity. We're talking about a firm showing some massive operating leverage.
Now, here is what makes this such a high-stakes valuation challenge. The current price is hovering around $212.74, literally inches away from its 52-week high of $219.16. With a PE ratio over 19 and a market cap north of $335 billion, it's undeniably a fantastic company. But, we have to ask, is it a great stock at this price? Let's find out.
Section 2. The Warren Buffett Lens, Seeking Moats and Margins. Our first gauntlet test comes straight from the Oracle of Omaha. When Buffett looks at a company, he demands a wide economic moat, rock-solid financials, and exceptional management.
So, the crucial takeaway here is that Morgan Stanley easily passes Buffett's strict quality checks. Just look at the moat. They manage a mind-boggling $9.3 trillion in client assets and wealth management alone, with margins over 30%. Their earnings are incredibly consistent too, pulling in a record 3.43 EPS this past quarter. And that 21% overall return on equity, that is exactly the kind of efficiency Buffett loves. Now, the debt-to-equity ratio sits at 3.52, which might look a little high at first glance, but for a major bank, that's actually completely standard and manageable.
But as we all know, identifying a wonderful company is only half of Buffett's equation, right? He absolutely requires a strict margin of safety. Knowing that banks proxy owner earnings through dividends and net income, we really have to ask if buying at nearly $213 gives us that essential downside protection. Spoiler alert, as we dive into the intrinsic value numbers in a minute, we're going to see that Buffett would probably admire the business but totally balk at the current price tag.
Section 3. The Peter Lynch Lens, Categorizing the Growth. Let's move on to Test 2 and apply the Lynch framework. He famously categorized stocks to really understand their growth narratives.
Looking at its massive size and maturity, Lynch would immediately peg Morgan Stanley as a stalwart. This is your reliable giant. You aren't buying it for explosive 10x growth, you're holding it for steady compounding and downside protection. And with a recently bumped $4 annualized dividend yielding 1.9%, it fits the stalwart profile to a T. Now, this creates a really fascinating Lynch conflict. On the plus side, a PEG ratio of 1.55 is entirely reasonable for a bank, and a 15.1% CET1 ratio means their balance sheet is basically a fortress. But here's the flashing yellow light for Lynch. Institutions own a massive 84% of the stock. And worse, insiders are cashing out. Executives recently sold millions in shares. For Lynch, that combination of high Wall Street ownership and insider selling is a massive signal to tread carefully.
Section 4. The Benjamin Graham Lens, the ultimate defensive check. For Test 3, we're stripping away the qualitative narrative entirely and facing the cold, hard mathematics of Benjamin Graham.
Graham relies on this super strict intrinsic value formula to find defensively priced stocks that inherently limit downside risk. Basically, you take 22.5, multiply it by the earnings per share and the book value per share, and then take the square root of the whole thing.
Let's actually walk through the math for Morgan Stanley. We take that base multiplier of 22.5. We multiply it by the analyst consensus for 2026 earnings, which is $11.97. Then we multiply that by the current book value per share of $66.18. Multiply all that out, and you get roughly $17,800. Take the square root, and boom, we hit a hard fundamental floor, $133.51.
The gap here is literally staggering.
At over 212 today, the stock is trading massively above Graham's intrinsic value of $133.51. For a strict Graham defensive investor, there is zero margin of safety here. None. They would demand the stock drop by an astounding 37% before they'd even consider touching it.
Section 5. DCF and Other Models. The quants weigh in. Having survived the historical legends, well, at least their quality checks, Morgan Stanley now faces Test 4, the modern quantitative models.
Now, we all know bank cash flows can be notoriously tricky to forecast, but using a standard 5-year forecast, we can model this out. Assuming a 10% weighted average cost of capital, which factors in the stock's 1.23 beta, and a mature 2% terminal growth rate, our base case scenario shows the DCF fair value hovering right around $148 to $150. Even if we get highly generous with a 9% WAAC and 2.5% growth, the absolute highest fair value we can mathematically justify is $178.
To double-check our work, let's run a secondary dividend discount model. Since this is a mature stalwart, this model is highly relevant. Using their newly bumped $4 payout, a conservative 8% cost of equity, and assuming they can grow that dividend by 5% perpetually, the model yields a fair value of $133.33. Guys, that is eerily similar to Benjamin Graham's calculation.
Section 6. Synthesis and Final Verdict. Putting it all together. Okay, let's move to the climax of our explainer and see how all this builds into a final, actionable verdict.
This scorecard really lays it all bare. Look, Wall Street analysts are incredibly optimistic right now, with a consensus target of roughly $206. But the rigorous value models, they paint a totally different picture. Graham is at $133, DDM is at $133, and the DCF is at $148. Every single fundamental model suggests the stock, which is sitting near $213, is priced for absolute perfection. The market is basically pricing in flawless execution and completely ignoring any potential macroeconomic hiccups.
So, taking all of this into account, our final blended recommendation as investment analysts is a hold. Don't get me wrong, Morgan Stanley is an incredibly high-quality business with an elite moat and a fortress balance sheet. But the valuation is simply too hot right now, especially with insiders actively selling. If you're a growth-oriented investor, set a buy trigger around $148, where the DCF model suggests fair value. But if you're a disciplined value investor following Graham or Buffett, you really need to wait for a significant market correction to pull this stock down to that $133 range to secure your margin of safety. As we wrap up this deep dive into Morgan Stanley's valuation gauntlet, I want to leave you with this final thought. When the fundamental math and the current market completely disagree, which framework will guide your next move? Do you trust the optimistic analyst targets or the cold, hard discipline of the legends? Think on that as you review your portfolios. Until next time, keep learning, keep analyzing, and stay focused.